Welcome you all friends again. We are meeting towards a new chapter, a new beginning for an important chapter in relation to the financial statements. Till now we had understood the financial statements, its making process and all that basics, wherein we understood the types of accounts, the debits and credits, and with that we understood how to prepare the financial statements. Hope you would have understood the financial statements, the statement of position and the statement of income. So completing with that, the basics accounting machinery have been completed. Now it is time to understand the different aspects and components which are there into the financial statements, and one of that very important component today that we are going to start with is inventories. Friends, it is a stock, it is a goods, something which we basically purchase and sell in a daily routine of business. This is the basics part that we will going to understand into the financial statements, including for the part of inventory only. Friends, the very important resource of a entire business, and that resource here is a inventory, a stock, a goods. Somewhere there are different things we will learn in terms of how to calculate the value of the stock. There are certain methods. There is legal requirement from the International Accounting Standards, IAS number 2 is there, which is a legal bounding for the valuations, for the presentations, etc. for this inventory part only. So let's take a look towards where we had understood this inventory, something called as a stock, opening stock or closing stock. See friends, we understood into the financial statements, as you can see over here, the financial statements that includes the income statement and the statement of financial position. In that we understood in the statement of income, the thing known as the opening closing inventory is a part of cost of sales, and the closing inventory out of that was also a part of the statement of financial position. So here you can see the interlinking for the stock, for the inventory between these two statements as indicated by this arrow. So hope you understood. We just had a look towards where and how it was presented, but friends, it is not only how to present it and where to present it, it is also relating to the valuation, its calculation, its counting and all for the stock, because it is the main resource which is running operation of a business, continuous sale and continuous purchase. So accordingly, we keep a look in this chapter, we will keep a look towards how we will calculate, and the different methods for that also is a part of learning in this chapter for inventory. Take a look towards another portion. So friends, as you have understood that here we have taken a look for how it was there into the financial statements, where we understood the cost of sales, or which is also known as the cost of goods sold. That amount is basically including the opening stock plus purchase minus the closing stock. Friends, why the closing stock was deducted from the cost of sales? As simply the logic behind that, it is not sold till now. At the year end, shop was there, and even the goods were still lying on the 31st of December. It is not sold at the year end. So accordingly you must deduct it. Another important thing, as it is also asset, it will be taken to the debit side, or say sorry, it is asset side of the statement of financial position. As per the accrual concept also, you can say here the closing stock was not sold, you must take it out of the current year cost of sales, and if you deduct it, then you get the total profit for the year. Why? See friends, it's very simple logic. Why the cost of sales being a part of the statement of income? Anybody who is doing some purchasing and selling and trading activities, what he will do? Basically, he will gonna purchase it at lower amount and will gonna sell it at a higher amount. So it's a very basic logic that the sale you make and the cost for that purchase to sell it was lower than that. So if it is lower than the sale price, then you are into a profit. Something extra you earn, that's a profit. Something you sold, the cost of that sales is derived by the given formula over here. As you can see, the formula is given in which there is opening stock plus purchase minus the closing stock. Take a look towards this, because friends, now herewith we will going to take a look how this closing stocks and all that will going to affect your income side, will going to affect your total incomes and all. Take a look for that. So as you can see over here, it is written the logic behind finding the cost of sales. It is very useful to find the profit earned into the income statement. Friends, which type of questions can be there which you can be encountered with? For this inventory chapter here, you can be encountered with the cost of sales, encountered with the different methods and all that. So for that, let's start for a practicing sum. Here the question 1, which relates to, as you can see over here, you can find a very simple basic formula which relates to how to calculate the gross profit. Friends, take a look towards the slide over here. The last portion is saying that if we deduct this cost of sales from the sales, it gives us the gross profit. Take a look here in the question. In the last line, you have been asked to calculate the gross profit for 31st December 2007. Here the goods by Peter has been sold, purchased and all that. It was trading throughout the year. So out of that, the total 1st January 7, friends, keep understanding that this 1st January 7 is opening inventory. 30 washing machines were there. The total cost 9,500, the $9,500. Friends, this amount of washing machines and the numbers are opening inventory. The 1st January, the opening date will be a opening stock and all. Then after, during the year, the sale and purchase transactions carried out, in which in a second line, or sorry, here the third line, you can see the 65 machines were purchased, total of $1,50,000. Friends, it is very important logic basic behind it that opening inventory were there and new additions like a purchase was made because the goods coming in, so it would have been debited. Obviously, physically goods numbers have increased. It was earlier 30 washing machines, right now 65 washing has been added. So this machines has been added. Total 95 became. But here on a 31st December, 25 washing machines were left into the inventory with a cost 7,500. Friends, closing at the year end. See, throughout the year, some machines purchased, sold, purchased and sold were carried out. Here 25 machines at last on a 31st December end of 2007 were there. It's a very simple logic that it was 30 earlier, 65 were more added, 25 left with us. Other machines, where it went? Friends, obviously it have been sold. So here the sales also has been given to you, a 70 machines having the sales value $2,15,000 in a year. You have been asked gross profit. Just remind what is the formula of a gross profit. The gross profit formula is a sales minus the cost of sales. So let's have a look towards how do we gonna solve these sums, starting with some formula basics. The the gross profit is equal to sales minus cost of sales, in which the sales you already have the 70 units amounting to like $15,000. The cost of sales, also known as the cost of goods sold. Here, the cost of goods sold being the opening inventory plus purchase minus the closing inventory. In terms of amounts, you can see over here. Okay, so hope so you would have understood how this 63,000 gross profit has been arrived with. See, total, the units of sales and the cost of sales units have some interlinking. Friends, you can easily say that. Here, whatever the sold was there, see, 30 units were there opening, 65 you add, and if you deduct 25, whatever been left, obviously the another gap between this opening plus purchase and the closing, that gap is only and only your sales, your units. 70 units has been sold. So accordingly, you get this 63,000 at your as your gross profit over here. Friends, this will become part of income statement, where we will going to understand how this gross profit was made up and all. Friends, today we will also connect it to the financial statements, because the closing statement, the closing stock and inventories, all these are part of that financial statement, which we will going to understand in terms of income statement especially, and the statement of position. So let's move further for another. See friends, obviously, as we have understood, the first step towards this accounting machine to run is always to record the transaction, to record the components, the record of assets, liabilities is also there. The closing stock is asset. Friends, we will going to put up this closing stock as an asset. For that, we must record it. Somewhere it is very fluctuative. Why fluctuative? Just imagine a shop where in a shop these goods are coming in, going out, coming in and going out very frequently. So basically for that you must have some records. An inventory account you should prepare, where coming in is debit, going out is credit. Hope you would have understood in terms of real asset or in terms of expense or income as well. You can understand in a two of the way. Expenses will be debited, the purchase expense is a debit, but the sales is an income, is a credit part. Friends, real asset type going in, like see, coming in and going out will be even better approach to consider how the goods are coming, going, etc. How to record this? See friends, over here you can understand the recording of these inventories will be done in a manner by a debit credit rule also. But here the closing rule of the accounts, you would have understood, please remind that we took the understanding of balancing of the accounts. We understood that the closing of current year will become the opening for the next year. The opening inventory of the current year is brought forward from the carried forward of last year. So this brought forward opening inventory is there. Even the sales and the purchase taken to the inventory account. Here is basically a cost of sales account you can see. Friends, whatever a goods coming in was already debited. At the year end, this amount will taken to the debit of the income statement. And then whatever was credited will be credited at the year end to the income statement. Friends, if there is a opening stock, so the opening stock was a debit balance, obviously it's a asset. So asset having a debit already was debit balance, now will be credited and will be debited to the income statement. So the entry will be the debit income statement, credit the opening inventory. Another we say sales and purchase. at the year end is taken to the income statement. How? When we purchased it, we debit the purchase, we credit the cash or supplier. Total throughout the year, whatever purchase going on and on and on, there will be some total of the purchase. At the end of the year, the total purchase will be credit and the income statement will become debit instead of that. Because in the purchase account, you will find the balance total, but yes, you will not gonna balance brought forward or carry forward. You will take it to the income statement. Friends, the most important line you must remember that anything which is part of income statement, those accounts are not balanced off, they are closed off. It is taken to the income statement, totally closing. But as far as for sales, it will be reverse, because sales, when it was a sale transaction occurred, we did like cash debit or a debtor debit or a receivable debit to credit was the sales. Now, throughout the year, credit was sale, credit. The total sale credit account was going on. At the end, into the sales account, total of this credit will be debit and will credited to the income statement. Here you can see we have taken an understanding for how debit credit will be there. Friends, if you understand better in a T-shape account, I will suggest that you should go with the flow of T-shape account, balancing it and taking it to the income statement. The debit and credit rule is important while recording the transaction. This is the time where we are preparing the financial statements at the year end. Here you just go in the flow of totaling the balance, debit, credit in the name of the income statement, vice versa for the sale purchase. Friends, now the time comes about a closing inventory. Friends, closing inventory is not a transaction. It's an event. Why the event? You will not gonna do something efforts to just have some closing stock. It's very obvious. You had some purchase, you had some stock already, opening stock, and you sold something out of it. So at the end of the year, certain stock is there. It's a result of opening, purchase and sales. But yes, this closing stock will become part of the financial statements. In a way, it will be debit, the closing inventory, and credit to the income statement. Again I am saying it will be a debit to the closing inventory because it is asset at the end of the year. Friends, so basically the closing stock is being an asset, so will be part of the balance sheet as well, in which we're gonna understand how we will show it up in a income statement and the statement of position. But yes, importantly, this closing stock is not a transaction, it's just an event, and it's being adjustment at the end of financial year. So there are two effects of it. But for the sale and purchase and all that throughout the year, only one impact, to transfer it to the income statement will be there. Okay, hope so you would have understood. Now let's take a look towards how we will going to find it out, what will be the closing stock, the amounts and the ledger entries. Friends, it is a holistic question which includes how the trial balance will look like before making the closing balance adjustment and after making the closing balance adjustments. The ledger accounts will be balanced off or closed off. I will say closed off is the correct word for the income statement. See the question, first line. Friends, it is very imperative for you that you are preparing the notes alongside with this video, where whatever I am talking to and saying some important words or the important concepts, it is not part of this slide. Maybe it is important and you should note it down along with this. So friends, let's take an understanding. Here if we are continuing the previous question where we understood that there was a 6300 gross profit, how will that would have been made up of? Throughout the year the transactions were there. Now let's see how the ledger accounts will be there. A and B, two questions are asked. The first question relates to A point, which states that immediately before extracting the trial balance, please consider ledger accounts you need to see before trial balance and immediately closing of the ledger accounts after the adjustment. A and B. We are heading towards the first requirement of question, that is A, stating here, friends, there was an opening inventory. Please just remind the previous question wherein it was the opening inventory on the 1st January 9,500. How much machines? Please understand, you have seen this, 30 machines, washing machines were there, 9,500 was the amount. So the ledger balance of this opening inventory was a debit balance, obviously, because it is an asset. See, you can see the balance brought forward is the word that has been used into the ledger. This is opening stock, this is opening inventory, which was carried forwarded from the last year. Another one, purchases. Friends, throughout the year of 2007, a different various purchases in a cash or on a supplier credit basis, it was there. So here this amount 1,50,000 various purchases is debited. Obvious purchase where the goods are coming in in the name of purchase, debit. Same way you can see into the year 2007 there were various different purchases, 365 days, 2,15,000 the total of it. But friends, yes, remind again how much units were sold. As you can see over here, total 70 units were sold, 65 even purchased also. So I am just connecting with that question the debit credit, the ledger posting rules also. Friends, here it is very important and imperative for your practice as well, for the total machine work for accounts, the debit and credit, so that it is good enough to connect it every time with the ledger postings also, so that it can be a better practice for you. Yes, so we are talking about the sales revenue 215, it is credited. Why credited, friends? See, you can consider it credit by two way. You say the goods are going out when we are selling the goods, so goods going out in the name of sales, the sales is credit at the selling price. Or you can say sales is an income and income is credit always. Friends, you have to learn by heart the concepts relates to the different accounting rules, okay, for the debit credit. We had taken care of in the second chapter. You have to be very careful and very much expertise level of practice you should be. Friends, this was before extending the trial balance. This was the entire portion. See, now after that, whatever this balance of inventory, yes please, the opening inventory now, it was there in the closing inventory of the last year. Now herewith we will going to take it to the income statement. It will be debit in income statement because right now it is debit. It will be on a credit side. Income statement will be named when we will going to see the balancing. Friends, trial balance is before calculating any of the closing inventory. So here right now we don't have this amount closing inventory, we didn't understand that thing. Let's see now, balancing will be done in a way like before the trial balance only the basic balancing was done. After that, whatever the balancing for the opening, for the purchase and for the sales amount now will get reversed and will become a part of the income statement. Friends, here the journal entry is taken. The things which were balanced into the accounts now will be taken to the income statement. Sale was credit entirely. Now the sale become debit and income statement will become credit in the total amount of $215,000. Same way, whatever the purchase in total was debited throughout the year for the different purchases, now it will become a credit and will become a debit into the income statement, 1,50,000 in total. See, when we made this transfer, another important point, the opening inventory. Friends, in an income statement, the cost of sales will become part and it will be deducted from sales. So accordingly, for the cost of sales, here we have to take all these three things, that is opening, that is purchase, and that is closing stock also, and the sales, it is imperative. Opening inventory, friends, it was a debit balance already as an asset which was carried out from the last year and brought forward into the current year. Now this opening inventory having the debit balance, a debit now become credit and it becomes a debit of the income statement. Yes friends. Now the thing comes towards closing inventory, the most important criteria. The closing inventory is not a ledger which is throughout the year. No, because whatever I am left with, say number of goods, this and that, friends, I am able to get that amount only at the year end. Throughout the year, I did all the purchase and sales were going on and on. But here, at the year end, I get this stock, the inventory which is asset for this year end. And this asset now will be debited in the name of inventory, which will be part of statement of financial position, 7,500. And in the income statement, it is a credit effect. Friends, why credit effect? Take a look into a last slide also. The purchase was a debit in the income statement, debit income statement. Even this opening stock, opening inventory 9,500 was a debit impact. Friends, you can see the opposite of plus is minus, opposite of debit is credit. Obviously, in a cost of sales, if we going to deduct the closing stock from the opening plus purchase, we have to take this closing inventory, closing stock in a credit side, and in the credit side 7500 income statement is there. You can see the entry for the transfer making of this closing inventory is there. So as we have taken the transfer entries, friends, it was a transfer entries to close all these things which are part of income statement. Now it will look like this, wherein in the inventory you can see on a debit opening, debit opening 9500 and the closing which going on with the 7500. Friends, on a opposite way of 9500, the opposite side, you can see income statement is named. It has been taken there. Same way 7500 keeping as a carried forward, and here you can see in a downward diagonal side. Yes, please again see 7500 downward diagonal side. It is taken as an opening balance of the next year coming 2008. So here this 2008 opening stock will keep on in the balance sheet right now for this year 2007. Hope so you are understanding the way how these balancings are going on. Friends, right now we are in 2007. Please don't be confused with the 2008. It is just for your understanding how the balancings are transferred for the assets and liabilities only. Friends, inventory is an asset. The last year stock 9500 became the balance which was brought forward this year, this time transferred to the income statement on the opposite side. See, the second ledger we have the purchase ledger. Friends, various purchases were there, was debited. Now it is totally closed. Both the side became equal and it has been taken on the income statement. Friends, in the purchase it has been credit. On a credit side you can see the name income statement. means in the income statement it is debited. Yes, so take a look towards the another ledger, that important ledger that we have, the sales revenue ledger. A sales revenue ledger indicating on a credit side 2,15,000, and in which we can see here the debit is on income statement. Yes, freeze. So in an income statement it would have been credit. This sales revenue account is also income part, and income and expenses are closed off. There is no any balancing of this. You can see there is no diagonal brought forward and carried forward and all that. No friends, you can see here the 215, both the sides, the sales account has been closed off, in which there is total various sales are there on a different date which we have not considered here. So as of now, as you understood that the different sales, the purchase, the opening and closing inventory has been transferred, friends, here our gross profit into the income statement. Say if I make this income statement in a T-shaped form, here it will look like, in which we get this 63,000 gross profit. On a credit you have the sales revenue and the inventory, and on a debit you have this purchases and inventory. Opening it is. So you can see the difference coming. The gross profit was carried forward for the other expenses and the net profit. If I just prepare and just show it in a T-shape account, I'm talking about the income statement. Here it look like 63,000, the gross profit we arrived. Take a look in the answer of the question 1. Yes friends, we did the same thing. But friends, this was a vertical format, a statement wise format. Friends, as your major questions in the exams are like MCQ objective basis, you won't be having any trouble regarding any of the presentation, because you won't just have to calculate as per your conveniency. You can consider this formula base, and sales minus cost of sales, GP is there also, friends. But legally saying, most of the LLCs, the companies, the LLPs, they have to compulsorily follow this method or this presentation way, a vertical format. Yeah, a simple proprietor or a partnership firm can go for the T-shaped format as indicated over here. Yes. Friends, it was just a basic understanding for how did we derived the gross profit of the first question. The balancing of the accounts got connected here. It was a good revision regarding the last chapter wherein we understood the balancing of accounts and all that. So it's time now to head towards another important and equally weightful question regarding how we will going to look at into a different two period. Friends, if say there is a break of a one period wherein the closing stock was there, it becomes a opening for the next period, how these things will get connected. The third question here will give you entire understanding for that. It's a long question. Might be possible that it becomes part of your 30 marks descriptives which are there in your exam, 70 and 30 ratio. Hope you would have understood that. Friends, here the third question, which provides the trading position, a simple cash based business. Yes friends, it's a cash based business. The first week was there. The first week started, and in which we have some of the capital which is introduced. Friends, what it means, the first week. Again read the first week, the word is there. Friends, it's a newly started business, and here this business have the capital which is given by the owner. Friends, always for any of the business, the first transaction will always be an introduction of capital by its owner. Friends, the owner has brought this 1,000. See, all these are basic transactions are there. Let's say we are here discussing with some debit credit rule. Please just write that debit and credit. I am dictating that, and With that, you just prepared roughly some T-shaped accounts of a different debit credit accounts. That will be a basic and very important understanding for this. Let's start with the first, the capital introduced by the owner. Cash coming in, debit, and it is a capital brought by the owner for the business. So the business having this liability for the owner towards the owner, it is known as internal liability, known as capital. Capital is credit, the cash is debit. Hope so you understood this. Now friends, purchase for cash, another one. Purchase, the goods came in the name of purchase, money goes out, the cash. So accordingly the entry will be purchase debit, a cash credit. Next one, the sales for cash. Friends, here is a simple cash based business already stated in the first line. A sales is there, means the goods are going out, so credit in the name of sales, goods going out, sales credit. Money, cash coming in, so debit. Friends, hope so you would have written all these three debit credits. Going further into the next line, stating that at the end of the week, the first week is ended, the goods there were goods which had the cost 300 left in the inventory. Friends, the goods are there, still there at the first week end. It is a closing inventory, a closing stock. Friends, might be a question pop up into your mind that where is the opening stock? It must be there. Friends, it's a very basic logic. What is opening stock? It is a stock which was already there into the last year, was closing, right now is a opening. But friends, here the business has just started. It's the first week, there cannot be an opening stock. Into the first day or first year of business, there is never any opening stock. No. It is not brought forward of any last year. The business wasn't there. Friends, right now here the closing inventory at the first week we have 300. How can we take it to the debit credit? Again, rewind. Yes, please, you can remind it. Wherein, as an inventory is a stock, it's an asset, it is debit, and it will be a credit part of the income statement. So friends, income statement also consists of this debit credit part when it is made up of T shape. So let us head towards how we will going to look it into the trial balance and the statement of positions and the income statement also. This will look like the first capital transaction. You made this T-shaped accounts where the capital credit side, the cash is there. In between the year, the cash is also there. In account, you can see the purchase where the money goes out, the sales when money came in. So there is 1100 balance of cash. You made this cash as like it's balancing, it's diagonally, it is taken as a brought forward exactly. The sales revenue is there. Friends, look at this. The sales revenue now has been taken to the income statement and closed off because it is a part of income statement. Another transaction, purchase related. Here, the purchase, a debit cash was there because it was a purchase, goods came in debit and the cash credit. In the purchase account, you will write in the name of cash this 800. But yes, purchase is a part of income statement, and so when balancing in the purchase accounts, opposite side the total amount will be taken to the income statement. Herewith, closing inventory we have to consider and we must record it. At the year end, we got this inventory of an amount 300 is there. Friends, it was earlier purchased at so and so amount. Right now, out of that, you can see here we got total 300, which is taken at the year end to the income statement, the inventory debit and it will be credit into the income statement. Friends, on a credit side, there is some printing mistake. Please don't consider on a credit side. We had already discussed how the debit inventory credit the income statement for the closing inventory 300. Take a look for the income statement. It will look like into the first week that we have. The purchase is on a debit. The sales is credit. Friends, gross profit is always found out by a balancing between the debit and credit side of the income statement. Yes, you can prepare this way also, the income statement, where a left hand side is a debit and credit is a right hand side, where you can see the sales, the closing inventory is there, and at the year end you get this gross profit of 400. So this 400 gross profit become part of a capital, will be added to that also. Friends, you can see the sales and purchase is already closed off and will be taken to the income statement. Now let's prepare the income statement. It was a ledger way. Now if the income statement we want to look like in a statement way, in a financial position statement also. Friends, here the inventory, the closing inventory will become part as an asset. It will be part of this statement. This is also known as balance sheet statement. The cash was there as the closing balance was taken up. Friends, always the assets, liabilities and the capital balance are taken as a brought forward and carry forwarded amount, either or, into the statement of position. The things like income expenses which are part of the income statement, they are closed and directly transferred to the income statement. They are not brought forward or carried forward balance. So friends, we had a look towards how this first week would have been carried out for the entire transactions that were there. Now here this is connecting question to practice the interlinking for this third question to the fourth question which is there. See, now the second week the business was continued business. Remember, in the first week the closing balance of the inventory, the closing inventory was 300. There was a cash balance also, as you can see over here, the financial position statement, the first week. This is end of first week, it is exactly a opening of second week. So into the second week we have the capital balance 1400, we have this inventory, we have this cash. This will become opening balance. In the second week starting, the ledgers of inventory, cash and capital, this three ledger will have the opening balance carried forwarded, brought down or brought forward. Sorry, it is brought forward. Take a look here. What is the question that has been asked? Into the second week going on business, the sales and purchases were there, and at the end of this second week this 500 is a closing inventory. Please read the question carefully. You have been provided, there is some sales, there is some purchase, the going on business, and at the end of the year of second week here the 500 is closing inventory. But friends, for this second week there is opening inventory also 300, which was the closing of the last week. It will get connected over here. So see what is requirement. Friends, here you are required to write up the ledger accounts for the second week. Okay, we're gonna do that, comma, including the income statement also that you need to prepare, and a vertical income statement together with the financial position statement at the end of the second week. Friends, you're gonna take a look towards the vertical income statement and statement of financial position. I will suggest that every time for the second and third chapter, which we have already completed, you must try more and more practical questions to understand its entire statement. You must remind entire statement in its vertical format or in a ledger format. So take a look towards how this ledger accounts. Friends, you can see the ledger accounts we are going to write up entirely throughout this second week. Some opening balances were there, yes, but it was only cash and capital part, and there was some stock also, but for the sales and purchase they were not taken from the first week rather. Friends, we are not carrying it forward back from the first week. Sale and purchase are always for the week, they are not at the end of week. Throughout this second week, as you can see, it is given that was some sales 1000, there was some purchase 1100. Let's repeat the journal entry for that. See here, the sale cash 1000. Entry will be sales, the goods are going out, so the sales, in the name of sales it is credit, cash is coming to you, so cash is debit, cash debit, sales credit. Another, the purchase for cash, wherein in this transaction inventory is coming, goods are coming in the name of purchase, so it is debit, and the cash is going out, so a cash credit. Again I am reminding, the cash credit and the purchase debit. Friends, in that way you will mix up with this ledgers, writing over here the sales amount and purchase amount. But friends, most important to remind it that on an opposite side of the ledger you will put up the income statement name, just because it is closed off to the income statement at the year end. Importantly, how will the stock ledger will look like? Friends, the inventory ledger hereby, whatever the 300 was there as the opening of this second week, because it was a closing of the first week, here this 300 has been taken upon, a brought forward balance was there, it is now transferred on the opposite side in the name of income statement, and the same way this 500 will become the carried forward balance as the closing side, but it is also part of income statement on a credit. Here this statement will look like, when the purchase and sale were entered into the income statement, it is always debit and credit. Friends, it is even better if you can just learn by heart the statement way or a ledger way, what will be credit or debit. It is very important to make the balances. Here the inventory was there 300 and 500, the opening and a closing. This will be your income statement look like in a vertical format. It has been written over here. In a vertical format, it is always sales minus cost of sales from top to down. Gross profit is coming. See here the sales were there 1000 total, second week. A cost of sales. How will you derive cost of sales? Please remind again the formula of cost of sales. Opening purchase, opening stock plus purchase minus a closing inventory or a closing stock. You have been provided with all that data as well, in which you had the debit and credit for these two. Here you get the cost of sales 900. So deducting the cost of sales from the sales amount, here you get 100 as a gross profit. Hope so you are understanding how these things are made up of. But friends, what about the second week statement of financial position? Here the statement of financial position, if you're going to prepare the cash account, having that 1100 opening balance also there. Friends, see, the amount you can see over here in the cash, it is not written over here, but friends, as you can see into the last question, the 1100 balance first week, at the end you prepare the ledger account opening balance of cash 1100, whatever the sale purchase you add up over there, you will get this cash of 1400. So accordingly, at the end of second week, here you can see the cash amount is going on with this 1000, wherein capital, friends, how this capital became 1400? Friends, inventory, closing inventory of second week, 1000 cash is there. Capital was at the start of week 2 was say around 1400, and this time also the profit has been taken to the capital is added. Most important learning out of this, please remind, a profit is added to the capital at the end, and if a loss, it is deducted from the capital at the end. Whatever the final answer, the final amount of profit loss of the income statement is either added or deducted to the capital into the statement of position. You can see over here this 100 profit. See, you have seen this gross profit 100 we derived into the second week has been added to the capital part 100 in the statement of position. Okay, so hope so you would have understood how the question was made up of for different two periods where the income statement consisting, even the closing opening stock, the connections between those things. Friends, we are learning the inventory chapter, the closing stocks and opening stocks, yes, but it is imperative part of the financial statements also. So it is very important to learn that also. Now another thing comes, how we will going to account for a drawings of inventory. What do you mean by that, friends? Say for example, you being a shop owner for some electrical items, you are selling and purchasing some electrical stuffs, which is household electricals as well, and at your own house, someday you need some of the electrical appliances. What you do? It's your own shop. You are the owner, but yes, friends, for the accounting, you as owner in person and your business are separate person. It's known as withdrawal, it's known as drawings. Now what happens? As a owner, at your home you need some CFL. You took some 3-4 CFL bulb out of your business. You took it to your own home, own house, using over there. It is, you used it for your personal, like personal benefit and all. Friends, very simply, it is nowhere that you will going to take it on a selling price from your business. Business is not selling you. You as an owner take it from the business without paying anything. Goods are going out, so it must be inventory credit, and yes, withdrawal will be debit, because withdrawal is reverse of capital brought in. So capital was credit when it was taken into business, something taken out of business, a withdrawal should be debit. Friends, important is how do we gonna account this? So as written over here, that we will going to take a debit to the drawings as well, and the cost of inventories or inventory account we will going to credit, just because business must record that this was the goods, these are number of goods which were taken out of business for the personal home use, and that is why the amount for that will be a cost amount. Friends, please understand, it will be a cost only at which it was purchased, because simply you yourself going to take the goods, you yourself will not charge a profit from yourself. You will not take a margin from yourself from the business part. So accordingly, this is a basic understanding for how to account the inventory when it is taken as a drawings. Many a times we would have seen many people as well having the same business of doing some, even a food product as well, or some let's say FMCG products also, wherein they utilize it for their own personal use, and it is very obvious. But yes, logically it is also obvious where we are not going to take it at a selling price. It is always a cost price. To record the inventory, here the debit credit is indicated, but always please take it at cost price. Drawings of goods will be always at cost price. Hope so you would understood till now the learning which is going on into the chapter. Here the chapter includes opening closing stock. Today we understood in the manner in which the income statement and the statement of position will include this stock, the opening stocks and closing stock stuffs, all that we understood.
If you like this video, share it with your friends. Subscribe to our YouTube channel to watch more such videos and learn from our expert faculty members. Press the bell icon to get regular notifications whenever we upload a new video. Download NDI mobile app to get complete CA course online. We value your support. Thank you for watching.